Bloomberg Surveillance, Early Edition, with Francine Lacqua.
Good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Here's what's coming up on today's program. No pivot, no doubt, no dilemma. Fed officials hammer home the message that tightening will continue. Today's jobs report may prove key. Oval Office angst. The White House scrambles to respond to OPEC's dramatic output cut. President Biden warns Russia's threat to use nuclear weapons is real. Plus, chipping away, Samsung profit sinks by a third as semiconductor firms warn of a breathtaking drop in demand. Now, first thing is first, let's check in on the markets. This is a picture overall. U.S. equity futures actually pointing to a lower start. I'm also looking at European stocks down some 0.2%. Of course, the picture and the only game in town is what we see with that U.S. jobs report, although we also had some semiconductor earnings that missed estimates, and so that's putting a bit of a concern on future expectations for avoiding a recession. Crude oil, 88.75. Yesterday, we had OPEC, Man's Cranny, with some really terrific market-moving interviews, and then a U.S. 10-year yield, 3.8428. The other story we need to watch out for, and I think we have charts throughout the day, is actually what's happening in the gilt market. We also have a deep dive in Bloomberg UK as we get onto the European map from our David Goodman and Phil Aldrich about how the BOE is still dealing with their nightmare scenario. Now, this is a picture across the board. You can see the FTSE MIB in Italy down 0.1%, so it's a similar loss to what we're seeing here in the FTSE. The CAC 40 and actually the DAX down 0.4% and 0.3%. So the drumbeat of support for rising U.S. rates continues as Fed officials stress the need to quash inflation. Neither market volatility nor an economic downturn will deter them from their goal.
I'd like to reach a point where policy is moderately restrictive.
I see us as raising to a level that we believe is restrictive enough.
Somewhere between 4 and 4.5% by the end of this year, and then hold at that level.
It's headed for 4.5 to 4.75% by sometime next year.
Holding it there until we see inflation truly get close to 2%.
Until we are confident. You have to understand the limitation of your data. You have to understand the limitations of your models, but you still need to use them to base your policy decisions on.
I think we're quite a ways away from a pause.
I anticipate additional rate hikes into early next year.
Well, we're now joined by Richard Saldana, portfolio manager for global equity income at Aviva Investors, and Christine Aquino from our markets team. So thank you both for joining us. Christine, just set up the scene for us. So the market is kind of like, yeah, okay, let's just wait to see what the U.S. jobs report. I mean, that changes everything.
Absolutely, Francine. I mean, we saw the earlier optimism in the prospects of a Fed pivot, which was very quickly quashed again by the chorus of policymakers from the U.S., really hammering home the point that they really are not done yet. And so we really seen a lot of the optimism fizzling out into the days closer to the jobs report, and now it really does feel like a holding pattern, and a lot really rides on the fact that this jobs report could be kind of what spells the difference between that pivot narrative staying alive or being just completely dead at this point.
Yeah, and this, Richard, kind of goes to the conundrum, but also, so before we talk about U.S. jobs, is there a concern that it's so difficult to read what these big moves, even from OPEC or the jobs report, mean for markets, that we kind of have this volatility on like equities up and then down, and how do you navigate that today?
Yeah, it's a really good question. And look, everyone's eyes will be on this jobs report later, and it sort of feels like right now the sort of current market psyche is bad news is good news, right? So it seems like people are hoping for a relatively weak number. Now, look, having said that, anyone expecting a Fed pivot in rates anytime soon, frankly, we think is misguided. Look, the fight against inflation remains the main priority. And the reality is, until we see concrete signs of inflation peaking, and the likelihood is that means not just one, but a series of data points for CPI and particularly core inflation trending lower, then I think markets are going to continue to remain under pressure. I mean, I think that highlights through the Fed officials that you showed said it all, right? It's very clear to us that central banks, their primary focus is getting inflation under control, and secondary is economic growth, frankly. So, look, for us, that means, given equity markets right now, it almost feels like the rate market is actually guiding the equity market, and we think that'll continue to be the case. But the key for equity markets, in our view, is longer-term yields, and that's really where you want to be focusing. So, yes, you can see, short-term rate expectations continue to trend higher, but the key for us is the 10-year yield, right? If you think back to the rally that we had mid-June to mid-August, and gosh, doesn't that feel like a long time ago now? That was primarily driven by that move lower in 10-year yield. So for us, focus on the 10-year yield is the key for the equity market.
But Richard, so if you believe that actually central banks will stop at nothing, right, to keep inflation under control, should treasuries be at 5%?
Well, look, I think again, short term, they can continue to push higher. There's no doubt about that. But I think that long end of the curve is where we will be watching closely right now in terms of the moves there. And I think that is really where you want to be focusing on right now. So we expect the Fed narrative to sort of continue to remain hawkish, right? I know, given where inflation is sitting right now, given the continuing pressures we're seeing, whether it be geopolitically, whether it be currently in terms of supply chains, et cetera, that are really continuing to pressure inflation right now. I think that hawkish narrative is here to stay for the time being. But I think, focus on that long end and see how that behaves to really give you a sense of, I think, how equity markets will behave on the back of this.
And Christine, one of our most read stories on the Bloomberg terminal and the website is basically what Bill Gross is doing and what PIMCO is doing.
Absolutely, Francine. It's the return of the bond bulls. Go figure. I mean, it's really interesting, right? Because we are at these levels of treasury yields where it finally is giving something back to investors after years, decades really, of very, very low rates and really not getting anything for your bond investments. But it's an interesting time, though, that this trade is coming through because it contrasts very well with the fact that, again, the Fed seems like it really will stop at nothing at the moment to really get inflation under control. And so, if you're somebody who believes that there is a recession coming just around the corner after the peak of the Fed cycle, then being a bond bull makes sense. But when will that trade start making money? Probably not until we see that peak, and that peak is currently priced for the first quarter of next year.
I feel like it's bell bottoms. They always come back. I mean, it's cycles.
It's cyclical.
It is cyclical. Richard,
bonds and bell bottoms.
There you go. I'm sure there's an index tracking it, maybe 2 standard deviation. We should get that out.
I'm sure there is, yes.
Richard, is there a chart actually where you look at to see something turning? And I don't know whether it's housing. I know we used to look at the consumer all the time, but housing is under so much pressure in various economies of the G7. Is that almost more telling than what the consumer does?
Yeah, look, housing is absolutely a key indicator, and look, we've seen in the U.S., significant, home price increases over the past few years, and understandably, we think that's going to cool down. Now, having said that, in the U.S., when you think about the market dynamics, there's still a significant, on the supply side, a significant shortage right now. So we think actually that will provide some element of support to U.S. housing for homeowners, already that are sort of sitting on a pretty decent amount of appreciation in that asset. We think, we think that'll still remain. And that's kind of why you've seen, I think, the U.S. consumer has remained relatively robust. But look, our focus is always on company fundamentals. And our view is still there's quite a significant dislocation right now between, underlying company fundamentals and share prices. So, whilst we're, it feels like we're in the eye of the storm right now in terms of that market volatility, the reality is I think you can find some resilience right now. And I think some value. We reference some of the companies in the tech sector, the likes of Alphabet, Microsoft, Visa. These companies are still generating plenty of cash. Balance sheets are really strong, in many cases, net cash on the balance sheet. And these companies have, sustained pricing power. So again, if your belief is that inflation remains elevated, and certainly, that feels like the case short term, we think, these companies actually have pricing power to deal with that. And, when Q3 earnings come through, I think that's one key element we will be focusing on is that pricing power of companies.
Yeah. Richard, thank you so much. Richard Saldana, their portfolio manager for global equity income at Aviva Investors. He stays with us, and thanks as well to Christina Aquino. Now let's get straight to the Bloomberg First Word News. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. The Thai Prime Minister is visiting the scene of the country's worst mass killing today after ordering an urgent investigation into the tragedy. A 34-year-old former police sergeant killed at least 38 people, most of them children, in a rampage which began at a daycare centre in the country's north. After fleeing the scene, the assailant returned home and killed his family before taking his own life. Now, a US judge has halted the court case against Elon Musk over his $44 billion Twitter buyout, giving the parties until October the 28th to complete the deal. The ruling is a win for Musk, who had accused Twitter of, quote, not taking yes for an answer after he revived his bid. Twitter had objected to that request to pause the case, saying Musk should close the deal next week. Swedish investigators say evidence points to recent ruptures of Nord Stream gas pipelines being caused by a deliberate act. The Swedish Security Service says its investigation has increased suspicions of sabotage, but did not indicate how the detonations actually happened or who might be responsible. And President Joe Biden is pardoning thousands of Americans convicted for possession of marijuana and ordering a review of its legal status. In a major step towards decriminalization, he issued a blanket pardon for all prior federal charges of simple possession and will urge governors to do the same for state offenses. The biggest ETF investing in U.S. cannabis companies surged 34% in an hour on that news. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Francine.
Leanne, thank you so much. Now, coming up, the European Union explores the idea of a cap on gas prices as leaders meet in Prague. We'll go there live next, and this is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance early edition of Francine Lacqua here in London. Now, EU leaders are arriving for talks on the second day of a European summit being held in the shadows of the war in Ukraine. Europe's energy crisis is set to dominate the meeting in Prague. While speaking last night, the Dutch Prime Minister Mark Rutte indicated that the EU could strike a deal on a gas price cap in the near future.
What you feel here is that there is an overriding willingness to make that happen. That, of course, we'll discuss that further between the 27. That will probably lead to decisions not tomorrow, but in the very near future. Of course, we have already done a lot, but we will discuss issues like could the price cap work? Is the Iberia model something we could replicate? How could we work on joint purchasing? All these issues will be discussed.
Well, for more, we're joined by Bloomberg's Maria Tadeo, who's covering the summit in Prague. Maria, the focus on a gas price cap. What can we expect from the meeting?
Yes, Francine, and to add to the comments by the Dutch Prime Minister yesterday saying do not expect a big decision, but a lot of brainstorming. Today, I spoke with the Greek Prime Minister, who was very tough on the Commission. He said we've already lost a lot of time. We need to see drastic, temporary, but drastic intervention in the energy market. Prices needs to go down, and he said the deadline by now is clear. There needs to be a proposal, something specific, and a decision to be made by the next European Council, which, as you know, will happen in Brussels on the 20th and 21st of October. So that is in 2 weeks' time. The Greek Prime Minister saying, the way I see it, that's her deadline. We cannot waste more time. Quote, we've already lost a lot of time.
So, Maria, there's a lot of urgency on this action to bring down gas prices. When could we actually see it happen for real?
Yeah, and Francine, that has been the back and forth, and we've talked about this since the end of August. Remember, prices were rocketing at that time. There has been some sliding in terms of the prices, but for a lot of companies, and in particular households, that is not enough. So this summit in 2 weeks' time is shaping to be, when you listen to some of the conversations behind the scenes, it's really the crunch moment for the European Union. Now, there is an energy ministers meeting that will happen next week. Perhaps I can iron out some of the technicalities. But the feeling that we get is that a decision, some type of decision on this price cap needs to be taken before the end of the month. And of course, then that means before November. And that is really when the winter season, the heating season for a lot of households really, truly begins.
Maria, thank you so much. Maria Tadeo there on the tough winter months ahead. She's covering, of course, that Prague summit for us. Richard Saldana, portfolio manager for global equity income at Aviva Investors, still with us. Richard, when you look at the winter months, what does it mean? And we go into the earnings season. What does it mean for a lot of companies? I know the smaller companies, or at least 20% of, for example, companies here in the UK say they may not survive the winter if it gets much, much worse.
Yeah, you're absolutely right. I mean, the sort of winter situation, I think, is going to be very key right now. And look, it's fair to say the current energy shortages that we're seeing in Europe, are going to mean increased focus, particularly on companies in terms of energy costs, etc. But we think actually there is an opportunity here in terms of the sort of pivot that we're going to see to more renewable sources of power, right? And that's going to mean, significant investment into, networks, electricity grids, and so, there are companies I think that can offer solutions here. You think about the likes of National Grid in the UK on the transmission distribution side. You think even to the wider European industrial complex, you've got companies such as Schneider, Siemens that offer products to help, manage electricity consumption in buildings, digitalization of electricity grids. So there are companies that I think will also have a key role to play, if you like, in terms of helping deal, with the challenges of the coming winter, and also just the sort of continued focus on the energy transition that's going to take place. So yes, certainly is going to be a challenge, but we also think will be an opportunity as well for some companies.
So, Richard, overall, where do you see, the earnings season, we I guess, got a warning shot from semiconductors and some of the chip makers. Where do you see value as we get into the earnings season?
Yeah, look, going into the earnings season, we actually expect earnings to remain relatively resilient. And that might sound, given the sort of challenges we're seeing from the macro perspective, a little hard to sort of understand. But look, the theme so far this year has been, companies have delivered pretty strong top line growth, and underlying demand still remains relatively strong across a broad range of industries, but you're sort of continuing to see that margin squeeze play out, and that's really impacted the bottom line. Now we think that's going to continue to remain the case. We don't expect large swathes of cuts to full year guidance for this year, but I think companies are certainly going to get questioned a lot more on their outlook for next year, and I think there's certainly some element of risk, if you like, to earnings there. But just to take your question just on the semis complex right now, and I think this is a really interesting area, because it's clear to us that actually that there's quite a dislocation going on right now here, right? So you think about areas such as PC smartphone markets, and you can see demand there is weakening. Some elements of saturation, we'd argue, on the smartphone side. But actually, if you look at demand for auto chips, industrial chips, that remains relatively strong. So what that's saying to us is that actually, within semis, if you're selective, you can also find opportunities there.
Richard, thanks so much. Richard Saldana, their portfolio manager for global equity income at Aviva Investors. Now, coming up, surging sin stocks. That's as President Biden takes a step towards decriminalizing marijuana. We'll focus on the sector next, and this is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, all sorts of themes have been in play in the stock market this morning. Misses from AMD and Samsung have hurt the chip sector. And in the sin stock space, cannabis companies rose on President Biden's pardon of marijuana possession. Now, the U.S. president is also ordering a review of the drug's legal status. Now, for more on all of this, we're joined by Joe Easton from our equities team. First of all, Joe, is cannabis, so first of all, the cannabis announcement is moving market. So let's just think about that for 1 second. But is it still even a sin stock?
Well, that's the big debate, isn't it? Yeah, obviously, yeah, it could change now, given that he's announced potentially this review, and it might not even be illegal anymore. So, yeah, maybe we'll have to move it out of the sin stock category. Maybe we move it into ESG. You don't know. But yeah, there's obviously a few stocks moving higher in the US in pre-market. Tilray, Canopy, companies like that. Some of them are listed in Canada as well, obviously. And there was a good story our colleagues did on an ETF that soared about 40% immediately after this news. So, as you said, it's interesting to see the weed stocks being pushed higher today.
I mean, how many weed stocks are there? I see, promotionally, I don't know why they've targeted me, but there's always these CBD gummies that I keep on getting harassed by on Twitter.
Yeah, that's right. So in the US and Canada, there's quite a lot. So, there's probably around 10 or so. And then a few ETFs as well, a few different ETFs. In Europe, there's barely any, and that's because the laws are much stricter and much far behind in terms of changes in regulation. There's a few penny stocks listed on AIM, where the regulation's a lot lighter, and they're all up around 10% today. but it's mainly US.
Okay, so from Zin stocks to like scarcity stocks, what's happening with chip makers?
So chip makers, 3 reports out, 2 were negative, 1 was good. So Samsung and AMD in the US, they were negative. Samsung obviously in Asia. And Taiwan Semi was actually a bit better, their sales better than expected. So it's kind of played into the news that we've had recently where we had some cautious commentary around Apple's production, obviously one of the biggest customers for those firms being Apple with the iPhone production. But I think the most interesting thing is the clean energy space and the demand that's coming for the semis there. I think if you speak to investors, they think that that's probably undervalued. There's a bit of value there, I think.
I mean, I used to have the Glencore chief executive always say, look out for cobalt. We need cobalt if we're going to transition to green.
Yeah, those strange metals that get used and nobody really knows what they're for.
They get stuff done. Joe, thank you so much. Joe Easton there from our equities team. Now, we'll have plenty more, of course, on equities. We also preview the upcoming U.S. jobs report and what the outcome could mean for markets and the Fed's inflation fight. That's coming up shortly, and this is Bloomberg. No pivot, no doubt, no dilemma. Fed officials hammer home the message that tightening will continue. Today's jobs report may prove key. Oval Office angst while the White House scrambles to respond to OPEC's dramatic output cut. President Biden warns Russia's threat to use nuclear weapons is real. Plus, chipping away, Samsung profit sinks by a third as semiconductor firms warn of a breathtaking drop in demand. Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, the hotly anticipated U.S. jobs report due out later today has the potential to tip the scales towards another jumbo Fed rate hike next month. The economy is expected to have added 255,000 jobs in September, while average hourly earnings are projected to rise by 0.3% month over month and 5.1% from a year ago. Now, for more, we're joined by Marcus Ashworth from Bloomberg Opinion. Marcus, this is hard for me because I just really want to talk to you about the UK. I'm kidding. The jobs report in the U.S., what are you expecting from it?
Well, I think the interesting thing is that 250,000 is still quite a big number, though it's not actually, in recent terms, that big. I mean, it probably will be the weakest or lowest since April 2021. Nonetheless, it's likely to still lower that unemployment rate down from 3.6, perhaps by a notch. And the key, I think, for the Fed is just this labor market is just so strong, they cannot be seen to pivot, despite the world trying to push them, and even Treasury Secretary Yellen puts a little bit of shade on Jay Powell by saying that people think about the outside world, which is clearly suffering from the super strong dollar. But the labor participation rate's going up, the unemployment rate's probably going down. That is just super hot. You got people coming back into the market, and still unemployment's super low. So, it's very difficult. And we saw yesterday for a lot of Fed heads saying, we've got to stick with it, more rate hikes, no pivot yet. Don't talk about rate cuts until in 2023 at all. And I think they have to keep this up for as long as they possibly can until something really does break in the US. The housing market clearly is showing the first signs of that.
So are there any doves left at the Fed? Should there be, or do they just need to make sure that they get the message to the markets that they mean business?
They've been very impressive, the Fed, and sticking tight ranks, unlike, for instance, the Bank of England or even the ECB. They've done a very good job. Even people like Kashkari, Daly have been very clear that they are sticking with a line. The only one perhaps to move away from that slightly was Lael Brainard, who raised similar concepts to what Yellen, I mentioned earlier, had said, that there are issues about what's going on in the rest of the world, and that will come back and bite the US hard at some point. But for the moment, I think they're sticking together. They're going to go, I'm sure, 75 basis points on November the 2nd. Unless this payroll number is heavily negative and there's lots of other stuff of revisions, I suspect the overall picture is just, particularly in the labor market, is so strong, and they've got to keep the fight on inflation going hard.
All right, Marcus, thanks so much. Marcus Ashworth there with a nice little roundup of what we can expect from the U.S. jobs. And then when you speak to, of course, a lot of people about what they're looking for the U.S. jobs report is how the market interprets it. So there's two things. First of all, you see whether the economy is strong enough to withhold what the Fed does next. But of course, the main question, which is also after we had that huge news from OPEC Plus, is how the market interprets it. So one thinking is, of course, the economy is down, so they'll hike less. The other is saying inflation is the only thing that the Fed cares about. So it's the little nuances that may make a huge difference. If you look at U.S. equity futures for the moment, they're seeing a bit of pressure. Investors, again, awaiting that latest payrolls report. It's a similar picture. I think we can have a board up looking at some of the markets out there. It's a similar picture, actually, for European stocks. Federal Reserve officials dousing expectations for a quick call to rate hikes. European stocks opening lower. Now let's get straight to your Bloomberg Business Flash. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. Credit Suisse has announced a cash debt buyback worth some 3 billion Swiss francs, a show of financial strength after market volatility earlier in the week. The offer includes euro and pound sterling debt securities worth up to €1 billion and a separate offer for US dollar securities up to $2 billion. The bank shares have lost more than half their value this year after a series of scandals. Now, a US judge has halted the court case against Elon Musk over his $44 billion Twitter buyout, giving the parties until October the 28th to complete the deal. The ruling is a win for Musk, who had accused Twitter of, quote, not taking yes for an answer after he revived his bid. Twitter had objected to the request to pause the case, saying Musk should close the deal next week. Samsung has reported its first profit drop since 2019. Operating profit fell 32% to $7.7 billion for the quarter ending September. That data underscores the depth of a global PC and memory chip downturn. Sales also missed estimates. And that's your Bloomberg Business Flash. Francine.
Thank you so much, Leanne. Now, the UN's latest snapshot of global food prices show a slight drop, which has been the case every month since it hit a record back in March. Food inflation still elevated, and threats to crops remain in the wake of Russia's war in Ukraine. Well, joining us now is Megan Dursin-Albury, our EMEA agricultural reporter. So, Megan, what does the latest from the UN Food Price Index actually mean for global inflation?
Sure. So the data today from the UN says that food prices dropped for a 6th month in September. So that's quite a prolonged slump. It wasn't a dramatic decrease, only about 1% lower, but it brings the gauge now to its lowest since January. That's overall good news for food inflation. It means that, eventually this could trickle through to supermarkets. But obviously there's a lot of other factors that affect food prices as well. Things like energy costs, labor costs, transport costs, which have all been elevated, as you know. And one key thing we're still watching is, Ukraine crop exports have been picking up these past month or two after the deal had been struck for them to resume seaborne trade. But that deal is due to expire in November. So a lot is going to hinge on whether officials can agree to extend it and if Ukrainian agricultural shipments will continue in the months ahead.
So, Megan, what factors will influence food inflation in the weeks ahead?
Sure. So as I mentioned, the situation in Ukraine is pretty vital for food prices going forward. They are a major exporter, as you know, of wheat, of corn, of vegetable oil. Often, we're also watching, where demand stands, given that inflation has been buffeting consumers on all fronts. Will things like meat sales or dairy sales decline? Some of those more higher-priced food options. And as always, the weather is a key thing to watch. We're in for another year of La Nina, and all eyes are going to be shifting to how crops are faring in South America in the coming months. So those are some of the watch points we're all keeping track of here on the food price front.
Megan, thank you so much. Megan Dursin-Albury there, our EMEA agricultural reporter. Now, coming up, our exclusive conversation with the Pakistani Climate Minister, Rehman. We'll discuss COP and the humanitarian crisis in Pakistan following catastrophic flooding. That's coming up next, and this is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, we're just getting a bit of breaking news out of the ECB. ECB stepping up on pressure on banks to exercise caution on bonuses. Now, this, I'm sure, is in direct retaliation or certainly a slapping of the wrists to the UK and to this government that decided just a couple of weeks ago to no longer have that bonus cap. So we'll see where it ends up. But the ECB, who, of course, is the oversight regulatory body for a lot of the banks in Europe, saying that they should step up pressure on banks to exercise caution on bonuses. Now, climate change has been more visible than ever this year. Summertime rains, supercharged by rising temperatures, flooded a third of Pakistan. Estimates of the damage have tripled to $30 billion since the end of August. Now, the toll of destruction is hard to fathom. 33 million people affected, with at least 2 million homes wrecked or damaged. Now, the number of dead stands at around 1,700, and that's before counting those lost to malaria, dysentery and typhoid, plus a looming food crisis caused by ruined croplands. Joining us now to talk about the devastation is Pakistan's Minister of Climate Change, Rehman. Thank you so much, Minister, for coming on Bloomberg to talk about this. What exactly is the current situation on the flooding today?
Thank you very much. The current situation is, as you noted, 33 million affected, which is the meta climate event of the century. We know of no other country that has been ripped apart like this by climate-induced events. So now we are no home to flooding. We are home to previous floods or monsoons. It is nothing like this. We now have 20.6 million people in acute need. Still, we have serviced 33 million, as you're saying. We are trying and struggling to do that. But just for perspective, 33 million is 7 million more than a big country like Australia's entire population. It is a very large number to absolutely service. We are trying with, as you mentioned, a health emergency looming to get doctors into the crisis-prone areas, to bring to the table services to the 70% women and children that have been affected, that are 70% of the 33 million affected, and 4% of the population, of the affected population, is actually pregnant and giving birth in under, tarpaulins which are not necessarily hygienic. So yes, the malaria, the other waterborne diseases is the next big crisis, but we're still in the life-saving phase after 17 hard weeks.
So how will you fund some of these damages? Minister, do you feel like you've been supported in terms of money being sent to Pakistan?
Yes, we have been. I've just returned from Geneva, where we were co-authoring or co-sponsoring to the second flash appeal that the UN was kind enough to put out with us. And yes, that's been a hub for international donations to come in. Many countries have stepped up, both in kind and in resources they're transferring. But you see, my ask is very simple. It is that climate-affected countries whose carbon footprint is less than 1% of global GHG emissions should not be having to bear the burden of other people's contributions. And here we are, afflicted with an event, a catastrophe that nobody has seen before in living memory. And we are bearing the burden of it pretty much on our own, with some help from friends. And yes, people have wiped their eyes and felt very, very bad for the victims, because they're real people with futures that have just been, exterminated overnight. We have sustaining exogenous shocks to our economy, to our crops, to our livelihoods. And there's a real worry as to how we will just even finish the relief effort for 33 million, let alone rehabilitate and reconstruct that is climate resilient.
But so, Minister, how will the government make some of the mitigation projects, for example, given the tight financing that you laid out just now?
Yes, the mitigation is one of our concerns. It's a goal that we've declared, a contribution we've made at our nationally determined contributions, NDCs, and we are on course with that. But let me just also just say that a mitigation has costs associated with it. It is more about a just energy transition than anything else. And a just energy transition has costed at $101 billion just, very clearly without us changing from fossil fuels to totally going renewable. This doesn't even include the cost of transmission lines. We are, however, on course to renewables because, that just to help with our own import bills for energy right now with supply chains being so affected all over the heart of Eurasia. But really, adaptation needs to be at the core of even the COP27's agenda, because this is what developing societies are facing on the ground. An adaptation fund exists, but it has never been capitalized, nor are we able to access, access financing that responds to climate disasters with agility or the kind of speed and scale we need.
So, Minister, what do you need from COP concretely, and how will you manage to convince some of the countries that could give funding that this money will go specifically into climate projects where, for example, there's a stoppage of leakage?
Well, look, first of all, the entire COP conferences are now, the last ones, the last few, are premised on a bargain between what is known as the Global South and the Global North. That bargain has to factor in the most important thing right now, which is the survival of countries that are in the front line of climate change. I refuse to answer questions that are only on the agenda of richer countries that have gotten wealthy on the back of fossil fuel developments. And I will not be hectored and lectured about our other goals. Right now, it's a fight for survival for many countries who are in the front line, who are exposed in multiple calamities to global warming, to the vagaries of global warming. So adaptation has to be front and center, as does loss and damage. It can't be a talking point as it used to be. It is a very real issue. As I said, it's a fight for survival even for the island, the countries, the small islands. We, however, want to be we don't want to be adversarial. We want to be part of the solution, not the problem. And we are the leaders of the group of 77 plus China at this conference. We'll be chairing that. Our Prime Minister, our Foreign Minister, everyone will be here to make a strong case for climate justice, which is, as I said, the pivot of all negotiations at the last 2 or 3 COPs. That's what it's based on, and it must take into account both mitigation, adaptation, as well as loss and damage.
Thank you so much, Sherry Rehman there, Pakistan's Minister of Climate Change, with a very, very important conversation. And I know Minister will speak many times before and after COP27. Now, coming up, could the U.S. jobs report push the Fed to another jumbo hike? It's just a few hours away, so we'll keep you up to date on that. This is Bloomberg.
One, it's not substantiated by energy markets, by the global economy, or by any other metric. It was unnecessary at this time. Prices are already elevated. There was no real imminent threat of a major collapse in prices that would necessitate a cut. I understand that, having watched OPEC for a long time, there's a difference between what they announce and what they actually do. OPEC's quotas they're underproducing their quotas by more than the 2 million barrel cut that they've announced. So let's see if this actually has any impact whatsoever in actual production numbers.
Right.
We are going to continue to work at home and with our allies. So, one, we're going to work with our U.S. companies to ensure that they continue to increase production and make sure that we have the refining capacity. We're down a couple refineries due to some accidents and maintenance to make sure that we have enough inventory along the East Coast and parts of the Midwest and the West Coast to make sure that we have supplies. And we're going to continue to focus on bringing down prices. And to that end, we have still some work to do on the SPR.
Okay, Amos, there's a lot to unpack there. One of the reasons that OPEC talked about doing this was, in essence, to incentivize spare capacity. Higher oil price now to get more oil out of the ground, because if not, it's going to stay in the ground and there will be a shortage. if there is some truth to that, why not take that view with U.S. producers? Why go to your allies? We have oil here that we can get out. Why not pick up the phone to oil production companies and say, guys, what can we do to get you to produce more?
Alex, there's an assumption based in your question that we're not doing that. For the last, even publicly, for the last several months, we have had conversations with the leadership of almost every major oil producer in the United States, told them, what do you need to be incentivized to increase production? We've had that honest conversation. They have what they need. They do not need anything else. I've had this conversation with them.
But I think, on this, if we talk to the industry, they would point out that it's the threat of regulation down the road that's the issue.
Alex, I take issue with that.
Okay.
I don't think that that's actually accurate. I think, in fact, if you look at where it's always about where you put your money. CapEx has increased among the major producers in the United States this year. They're increasing production. They announced those increases in CapEx just several months ago, but it takes time for that to materialize in production. We've seen them increase production. We know that the projection is for them to increase production into 2023, the first couple of quarters of 2023. They have what they need.
Well, that was Amos Hochstein, the U.S. senior advisor for global energy security, reacting to OPEC Plus decision. Now, investors laser focused today on that key U.S. jobs print due at 1:30 p.m. London time. So that's more. I can't get my words out. I'm so excited about the jobs report. Let's bring in Jan Patrick Barnard for analysis on what to expect. So, JP, just give us a quick wrap of the action so far this morning, first of all.
Yeah, you're absolutely right. I'm excited as well on this jobs report. It's the next big data point that we are getting, and the market is a little bit sidelined right now as everybody is keen to see that number and what it means going forward. We saw several people laying out a little bit of a wish list for the rally to continue, and the jobs report is certainly on it. So as we said before, we want to see like this Goldilocks number that shows us the economy is cooling, that the job market is cooling, but it can't be too bad, so we avoid a hard landing in the market. In other things, we have chip makers presenting us earnings that were like breathtaking, missing expectations. So we see chip stocks in Europe falling this morning. And of course, we have the weed story, the cannabis story. ETFs were already rising yesterday on plans of the US administration to treat the drug differently in terms of legal or law enforcement.
So what does the market want to see from that jobs report? Because they've been, flip-flopping a little bit when we've had these big data, as it's unclear what that would do to Fed calls.
Yeah, absolutely. And the sentiment right now, or the consensus out there among the strategists and the investors that I talk to, is still that everybody is on the sideline on that latest rally, saying it's driven by technical factors and mechanical buying, and not really like due to a change of fundamentals. We have the oil story, which is not helping at the moment. So we want to see the job number, and more importantly, the inflation number next week as a helpful indicator that the economy is cooling.
JP, thanks so much. Jan Patrick Barnard there joining us from Frankfurt with the latest on the markets. Now, Bloomberg Surveillance Early Edition continues in the next hour. Matt Miller, Kailey Leinz in New York, Anna Edwards here in London, and this is Bloomberg.
We got to look at where the situations are fragile and where the higher for longer story could potentially break things.
The economy structurally is also changing at the same time that we might see some downturn dynamics driven by monetary policy.
If the volatility increases and you see a dramatic shift, either because the economy is much worse than we expect, or because of other factors we don't know.
If we have some positive surprises, the market's looking for good news, I think it'll react.
We do expect that the jobs numbers will be something for everyone, really.
This is Bloomberg Surveillance Early Edition with Anna Edwards, Matt Miller, and Kailey Leinz.
It's 10 a.m. in London, 5 a.m. in New York, and 5 p.m. in Hong Kong. Our top stories today. Waiting for a hot U.S. labor market to cool off. Investors in the Federal Reserve will be looking at today's September jobs report closely. raising fears of an Armageddon. President Biden warns that Vladimir Putin's threats to use nuclear weapons in Ukraine are real and wonders if there's an off-ramp. And Credit Suisse shows some financial muscle after a tough week. The Swiss bank is offering a $3 billion cash debt buyback. Well, welcome to Bloomberg Surveillance Early Edition. I'm Danny Berger in London, in for Anna Edwards. Matt Miller and Kailey Leinz are in New York. And Kailey, let me be the first to wish you not just a happy Friday, but a happy Jobs Day.
Indeed, and happy Jobs Day to you as well, Danny. 3.5 hours to go until that key payrolls report here in the U.S. We are all waiting and watching for it. Of course, in Asia, they had to trade before they got those figures, and it was broadly a down day when it comes to equities. The MSCI Asia Pacific Index as a whole down about 1.1%. Some real underperformance coming through from technology stocks. The Hang Seng Tech Index, for example, down more than 3 percentage points. And part of that problem has to do with the chip makers. After AMD here in the U.S. yesterday, after the bell, gave a third quarter preliminary view on revenue that missed expectations by more than $1 billion. So it fuels concerns about a demand slowdown in the chip space. And you saw that evident in Samsung's results as well. It reported a 32% drop in operating profit. Big decline there. What's interesting is you didn't see a big decline for the stock. It was down as much as 2% at one point in the Korean session, but ended the day lower by just about 0.2%. And of course, finally, as we await that crucial economic data, that jobs report here in the U.S., you are seeing some upward pressure on yields around the world. And that was definitely true in Australia, where the 10-year yield rose by 7 basis points, Matt.
All right, here in U.S. futures, we see a little bit of a drop, but really not much movement after the drop we saw yesterday, about 1% on the cash trade to 37.44 on the S&P 500. The 10-year yield coming up even higher now, 383.47. So those high yields persist. That could be a good thing for some investors who want return. It could be a problem for the stock market, which may be why we see some headwinds into futures this morning. The Bloomberg Dollar Index coming down a little bit, 1334, still at a relatively high level, but I think I saw some gains on the pound, for example, earlier today, all the way up to $1.12. Who's going to pay $1.12 for a pound? And then NYMEX crude coming up to 88.86. Still not a huge move considering the 2 million barrel a day cut, but of course everyone says it's only going to be 1 million barrels a day, and there are still those concerns about demand in a recession. Danny?
Matt, you ask who's going to pay for $1.12 a pound. I mean, me, I got to. My life is split between the UK and the US. Anyway, that's besides. It's okay. We all mourn for this. Anyway, besides the point, we are looking at European stocks off the lows. A lot of these regional benchmarks, little change. Again, it might be this sort of idea that we're just waiting for the jobs report. Starting the day out negative, we do have some of the Nordic regions, for those who can see the map. It's some of these up here. They are negative. It's a lot where the tech sector lives. So again, it's off that story, Kailey, you were mentioning some of the chip stocks doing poorly. But yes, we do see strength in some of these European currencies, be it the pound, be it the euro itself. But we're back in this environment where it's just about the dollar, really dominated by that. And it's trading in somewhat of a tight range today, just considering we are waiting for that jobs report. Elsewhere, the gain in yields, it's not just happening in the U.S., it's happening in Europe as well. We can't forget we had those ECB accounts yesterday where they talked about the need to continue to hike. There's also an ECB study out saying that it's the demand side that's increasingly contributing to inflation, which reinforces this need for hawkishness from the ECB. So German 10-year yields up 5 basis points, UK 10-year yields up 3 basis points. Goldman Sachs also warning that we might continue to see losses from UK 10-year yields. The worst isn't over, despite the fact that the BOE stepped into the market. Of course, those operations end next week. And finally, Nat Gas down 50% from its highs. Of course, that debate going on in Prague right now, Matt.
Okay, blah, 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 blah. All anyone cares about for the next few hours is the U.S. jobs data. Maybe backing the case for more Fed hikes. Maybe traders will see a pivot in it. Mike McKee, Bloomberg International Economics Policy Correspondent, joins us now for more on what to expect. Mike?
It's nice to be wanted, for a change, for at least a few hours. We're likely to see some numbers that, as one of the people said at the top of the show, has something for everyone. The forecast is for 255,000 jobs. That's the consensus of economists polled by Bloomberg, which would be a sequential drop, but not a drop off a cliff. 3.7% is your unemployment rate, no change. Average hourly earnings drop a little bit, which would make the Fed happy. The participation rate's interesting because the Fed's kind of given given up on that getting a whole lot bigger with so many people having retired and or having long COVID. The question is, what matters most to the Fed today? And that is going to be the jobs numbers. Now, for the last 5 months in a row, the jobs numbers have come in stronger than consensus. And if that happens again today, you could see a reaction in the markets. There's a lot of fear about what happens if the Fed has to go for longer and higher. But the line that you see, that if you were looking at the bar chart that I'm showing on TV, and you're not if you're on radio, but anyway, we've been seeing a sequential decline, a decline almost every month of those last 5 months, and that's what the Fed wants to see. They don't want to see jobs dropping tremendously quickly, but they do want to see them coming down a little bit. And then it starts to get real because we have CPI next week. We have the third quarter GDP at the end of the month, and then the Fed meeting on November 2nd. What are they going to do? And that's 1 week before Election Day. So a lot of things coming together towards the end of this month, and this is the kickoff for that.
Well, Mike, as you allude to, the Fed would like to see some softening. They would like to see slack in the labor market. What is the line between slack that's good and slack that's not so good and maybe causes them to blink?
Well, if they're going to blink now, it's not going to be because of slack. It's going to be because things get tighter. If we had a significantly higher jobs number, maybe over 300,000, then that would worry the Fed a little bit, worry the markets a lot. The Fed, though, thinks that it's going to take time to bring the numbers down, and it's going to take even longer for the unemployment rate to go up. So they're hoping that we just see a continual progress that shows their medicine is starting to work.
All right, yeah, let's hope it is, and so the medicine doesn't get much worse from here. Michael, thank you so much. Bloomberg's Mike McKee there, who will help lead our coverage of Jobs Day. We're going to hear from U.S. Labor Secretary Marty Walsh following that report. 9:40 a.m. New York time is when you can expect that, 9:40 p.m. in London. President Biden is worried that Vladimir Putin's threats to use tactical nuclear weapons are real and could lead to, quote, Armageddon. At a fundraiser in New York, the president said the U.S. is trying to figure out the Russian leader's off-ramp. Maria Tadeo, Bloomberg's European correspondent, joins us now from Prague, where EU leaders are gathering for a 2-day summit. So, Maria, these comments from Biden, how widely shared are they amid the European leaders that you've been speaking to there?
Well, Danny, to me it's been very telling that they didn't really want to comment on this. For a lot of Europeans, this nuclear subject is something that you don't just casually drop in a conversation. But again, this is going back to initial comments that were made by Vladimir Putin a few weeks ago when he said if the Russian integrity, the territorial integrity of our country is compromised, we have weapons that we could use, of course, alluding to nuclear. And he suggested this is not a bluff, this is not a joke. Then, of course, the president of the United States today, yesterday, hinting that this is something you have to take seriously. Not a lot of reaction from the French, not a lot of reaction from the Germans, but yes, there is reaction from some of the Eastern European countries who say, and they view this slightly different, they say that this is something that Vladimir Putin will always bring up, that this is bait. And if you take the bait, it is a sign of weakness. So when I spoke to the Lithuanian president, what he told me is, let's focus on deterrence, deterrence, deterrence. Let's make it very clear to the Kremlin that they do not want to test the limits to our response.
All right, Bloomberg's Maria Tadeo. Scary stuff. Thank you so much for your reporting. Meanwhile, we have some breaking news we want to bring you out of Oslo, Norway. The Nobel Peace Prize announcement has been made, and there are 3 winners for the prize in 2022. The first being Ales Bialatsky from Belarus, a human rights advocate there. The other winners are 2 organizations, the Russian human rights organization Memorial, as well as the Ukrainian human rights organization, the Center for Civil Liberties. All 3 have won this year's Nobel Peace Prize, Matt.
All right, very interesting stuff indeed. Let's get back to some company news now. A show of financial strength for Credit Suisse after days of concerns about the bank's solidity. The Swiss lender announced a cash debt buyback worth about $3 billion. It comes just weeks away from the announcement of a major strategic review, but maybe more importantly, just days after the stock hit an all-time low. Bloomberg's Charlie Wells joins us now for more. So, Charlie, what is Credit Suisse trying to accomplish with this debt buyback? There are echoes of Deutsche Bank here.
You know, Matt, this is Credit Suisse effectively trying to tell the markets, calm down, guys, we've got cash. Now, as you say, it has really been a week of superlatives for Credit Suisse, that share price lowest ever, credit default swaps on its debt highest ever. This seems like an attempt to turn that story around, but we hear this figure, 3 billion francs, $3 billion. Now, how significant is that? Well, it's actually relatively modest, and what that seems to indicate is that the bank could be trying to preserve some of its liquidity, which we should note is healthy liquidity for that potentially expensive and potentially extensive restructuring later this month.
Yeah, it's what we've heard from analysts that, look, their liquidity position, it is okay. So perhaps enforcing it, but they still have this deadline they've set up. Are they going to be able to calm markets? Is this plan going to work for them in the meantime?
Look, it's got to work better than that memo from exactly a week ago in which the CEO said, hey, we're in a healthy position on liquidity. What happened? You know, share price tanked, credit default swaps go up. So this seems to be executives putting cash where their mouth is. Now, what investors will really want, though, is more of an indication of that October 27th plan, right? In market terms, we're on what, the 7th of October? That is 20 days away. In market years, that is light years away.
All right, Charlie, thanks very much. Charlie Wells keeping us up to date on the latest in the Credit Suisse saga. We'll continue, obviously, to follow this until October 27th and beyond. Let's get to another big story that I've been watching really closely. President Biden has taken his first major steps towards decriminalizing marijuana on a federal level. The president pardoned thousands of Americans convicted of possession of the plant. He also ordered a review of its legal status. The pardons could affect more than 6,500 people charged with simple marijuana possession. And as a result, pot stocks shot up on the news, as well as the ETF. So you can see Tilray up 12% in the pre-market. Kailey?
Yeah, definitely a big mover, Matt. And another big mover we're watching this morning is DraftKings. It is surging by about 8.5% in pre-market trading after a report that ESPN is close to a new partnership with the sports betting firm. Bloomberg has learned the deal would pave the way for the media giant to capitalize on the growing wave of legalized sports betting. ESPN has already invested heavily in sports gambling, but it has steered clear of actually taking bets. Now, of course, the growth of sports betting and all of the latest odds you need to know are what is being discussed in our very own betting program here on Bloomberg, The Lineup. It's hosted by me and Damian Sassower, and that will be airing tonight at 7 p.m. New York time and 11 p.m. New York time, and again on Saturday morning. So if you plan on betting this weekend, make sure to check that out, Matt.
Absolutely cool. Can't wait to see the show, Kailey. Coming up on Jobs Friday, Antoine Bouvet, ING senior rate strategist, and Ryan Wang, HSBC U.S. economist, give us their take on what to expect at 8:30 a.m. This is Bloomberg. Welcome back to Bloomberg Surveillance Early Edition. I'm Matt Miller in New York with Kailey Leinz. Danny Berger with us out of London. Anna Edwards is off today. We are looking at, of course, we're looking ahead to the jobs number, right? But all that means, or all we need that for, is to try and figure out what the Fed is going to do. Right now, the market is pricing in a 71% chance of a 75 basis point hike in November. Joining us now is Christine Aquino, Bloomberg Managing Editor for Markets. And Christine, this seems to be the only driver of U.S. markets. What economic figures, what the macro picture tells us about what the Fed is going to do.
Absolutely, Matt. All roads lead to what the Fed is going to do in November and really for the next few months here. And, you know, I think this is really a very interesting kind of dynamic that we're seeing with the Fed debate, particularly this week, because as you recall, we saw that whole pivot narrative emerge at the start of this week, which is why stocks had their best two-day gain in quite some time. But that was very quickly quashed by what we've since heard from Fed policymakers. And that is the message is loud and clear. It is very, very hawkish. They're not going to be stopping anytime soon. And the priority is inflation. And really what the jobs numbers today will probably do is affirm that conviction in this tightening cycle, so long as it is not drastically disappointing.
So the Fed might be clear, but you still have Bill Gross, who likes bonds. his former colleagues over at PIMCO like bonds. I mean, there are people who feel like they're fighting the Fed to some degree.
Absolutely, Danny. It's a very interesting dichotomy that we're seeing now. I mean, just looking at the state of the bond market, it does make sense that you now have these bond bulls emerging and regaining their voice. Just because where Treasury yields are right now, very much a different picture from, say, a year ago, right? And so it makes sense for bond bulls to start saying maybe it's a good time to be buying now. They're cheap, and especially if you're thinking that a recession is just around the corner after the Fed rate peaks, then it makes sense as a trade. The problem is that with the Fed saying that they're not really going to be stopping anytime soon, and markets expecting that peak to not come until perhaps March of 2023, there's really not a trade that's going to be making money for the next 6 months. So, you know, if you're a bond bull right now, I think you're going to have to be patient and wait for those returns after that peak.
Christine, we've talked a lot in the last week or so about whether or not something is breaking or something is about to break, and ultimately if that is going to cause the Fed to change its course of action. Scott Minerd was talking about from where he sits, cracks are starting to form. Where will the cracks matter? What needs to break for the Fed to actually pay attention?
Well, Kailey, as we know, of course, the Fed's mandate is a dual one, right? It's about inflation, but it's also about the jobs market. And that's definitely the first port of call, especially when we start seeing those hiring numbers, perhaps some revisions to the downside coming through over the next few months. There's also, of course, the question of the level of wages in the labor market and whether that's showing signs of a peak. The other thing that I would personally want to keep an eye on is the state of the housing market as well. We know that it's a very important store of wealth for a lot of consumers, particularly in the U.S., but even elsewhere, especially here in the U.K., I would say is the same case. And so, you know, any signs of turning there would be very consequential just for the state of the U.S. consumer and where that story is going to go over the next year.
I hate to bring it away from macro, but we do have a lot of individual company news today out of the chip sector. Samsung had, I think, its first reduction in earnings since 2019. We had AMD pulling sales down or releasing sales that were more than $1 billion less than the street's estimate. Is the PC shortage in the chip sector a real problem?
Well, Matt, I mean, we can make this macro too if you like, but I mean, it does seem like it is a continuation of the shortage issues, but I would say it's also a reflection of just the worrying state of consumer demand at this point. I mean, particularly, you know, some of the companies that you mentioned very much rooted and levered to the Chinese economy. We still don't really have a lot of visibility in terms of the potential recovery there. There are some signs that some of the very bad data we got over the summer may be moderating, but nowhere really near the level of resurgence that you would want to see from the world's second largest economy. And that has very real impacts for the chip sector, both in terms of the demand levels there, but also in terms of the supply chain issues, as you highlighted.
Yeah, Christine, thanks so much for joining us. Great having you today. Christine Aquino on to talk about the markets for us. Of course, I didn't mean PC shortage. I meant PC overage, really. Shortage in demand. There are too many PCs. Chip makers can't get a bid, really, for their PC chips, and that's the big problem. For more market analysis, check out MLive Go on your terminal. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Kailey Leinz with Matt Miller in New York and Danny Berger in London. Anna Edwards is out today. Now, keeping you up to date with news from around the world, here's the first word. China is showing its clout on the world stage. The United Nations blocked a debate on China's human rights abuses in Xinjiang just weeks after publishing a report on the matter. The U.S. proposed draft resolution at the UN Human Rights Council was narrowly blocked. China has rejected allegations that it abuses Uyghurs and other Muslims. Bloomberg has learned that talks between Elon Musk and Twitter on his $44 billion takeover are stuck on debt financing. In a letter to the SEC, Musk's lawyers say the deal is contingent on receiving the proceeds of a $13 billion debt sale. According to an April filing, 7 banks underwrote the debt portion of the financing. And it's a sad day for 3 restaurants here in New York City. They have lost their stars in the Michelin rankings. Carbone, Maria, and Peter Luger have defined New York's power dining scene over the last few decades. Still, the city has 73 Michelin-starred restaurants compared to 68 a year ago. And admittedly, Matt, the only one of those three I've been to is Carbone, but it was really good in a not overhyped way, so I'm pretty shocked.
Yeah, well, I mean, I also love Carbone and especially love Peter Luger's, and the only takeaway I have from this is that hopefully fewer people will want to make reservations so we can more easily get a table there.
Well, also the common thread in this is that they're all steak restaurants, and as someone with the last name Burger, I am highly offended. Justice for red meat. That's all I got.
I don't even know how to follow that.
I like it.
That was too
yeah,
good.
fair enough.
Yeah.
There's nothing cool about the last name Leinz, really.
It's quite cool. I mean, in other ways. Coming up, Antoine Bouvet is the senior rate strategist at ING. Going to get his take on what we're going to hear about jobs today and what that means for the Fed. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. Here's what you need to know. Waiting for a hot U.S. labor market to cool off, investors and the Federal Reserve will be looking at today's September jobs report closely. Raising fears of an Armageddon. President Biden warns that Vladimir Putin's threats to use nuclear weapons in Ukraine are real and wonders if there's an off-ramp. And Credit Suisse shows some financial muscle after a tough week. The Swiss bank is offering a $3 billion cash debt buyback. I'm Danny Berger in London with Matt Miller and Kailey Leinz in New York. Anna Edwards is off today. And Matt, in your own words, blah, 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 blah. All we care about is jobs at 8:30.
That's right. I mean, everyone is looking forward to the jobs report. I will be glued to surveillance when it comes out. We are expecting, I think, 255,000 jobs is the survey. The whisper number is 258,000. So if you go on WHIS Go, you can see that and place your own bet, make your own forecast. Futures doing a whole lot of nothing right now after a 1% drop in the cash trade. Yesterday, we're down to 37.44 on the S&P in the cash trade. So I guess that will drive where we go today, right? In fact, jobs numbers, Valerie Titel, I believe, is going to join us in a few minutes and talk about the fact that these jobs releases, whether they come from ADP or JOLTS or ISM, are what has been driving the market lately. The 10-year yield up 1.5 basis points to 383, 384 right now, so a relatively high level and a little bit of a a headwind for stocks. Maybe good if you're an investor who wants a return. You're finally getting some juiciness there. And the dollar index at 1333 down just a little bit, so off against some of the other major currencies. NYMEX crude at 88.88. That should be good luck. But the problem is there was a 2 million barrel a day cut by OPEC. Maybe it's only 1 million, but there could be a recession which would drop demand for gasoline. Or that's the theory, right? We haven't really seen a drop in demand even amid the higher prices. So we'll see what exactly comes out there. Kailey, what do you see in terms of pre-market movers today?
Well, let's talk about pot, Matt, because of course we got the news late in the session yesterday that President Biden was going to pardon thousands of Americans for possession of marijuana and ordered a review of its legal status. So that is leading to some hope about decriminalization of the drug here in the U.S. And as a result, you are seeing big moves for some of those pot stocks. One of them being Tilray, which is up about 2.5% in pre-market trading, and MJ, which is a very aptly named ETF that tracks, or tickerized rather than named, that tracks cannabis names, is higher by about 7.9% in early hours. As for other big movers out there, one of them is DraftKings after a report late yesterday that ESPN is looking at a big partnership with the sports betting company. Really shows the gains in sports betting that is being made here in the U.S. That is just a massively exploding market. And of course, when I talk about on the lineup here on Bloomberg, but DraftKings is up about 8.3%. One mover to the downside and dragging other names with it is AMD, the chip maker here in the U.S., giving a preliminary third quarter figures. Sales coming in $1 billion under expectations, speaks to the slowdown we are seeing for demand in the chip space. So AMD is down about 5% and taking a lot of other related stocks down with it, Danny.
Well, same thing happening in Europe for sure. European tech stocks, the worst performing sector. But on a headline basis, we've just seen the Euro Stock 600 flip into green. It's up 0.1%. But we're just kind of floating along today, similar to what's happening in the S&P 500 futures session. Not a lot to do until we get that jobs number, perhaps just moving some things around, some window dressing. One thing potentially aiding stocks, allowing them to move slightly higher. We are looking at some of the losses today in the European bond market. They've paired ever so slightly, still seeing yields push higher. German 10-year yields, those up 5 basis points. UK 10-year yields, those are up 4 basis points. The drama and focus, of course, has been on the U.S., it's been on the Fed. But look, Germany 10-year yields, those are up about 50 basis points this week. We have an ECB who had accounts out yesterday saying that, yes, they need to keep hiking. So that aggression isn't going anywhere. But still, when it comes to the euro, really just trading off the dollar, Kailey. So weaker dollar, stronger euro, stronger sterling as well.
And of course, it all comes back to Federal Reserve policy, which today's jobs report will likely have some bearing on. Let's get a take now from Antoine Bouvet, ING senior rates strategist. Antoine, we have heard from a lot of Fed speakers this week, and they all pretty much reiterate the same message, the idea that they're going to climb up quickly to the terminal rate and they are going to stay there for a while. And yet the market is still pricing in a cut next year. You also are on team cut in 2023. Why aren't you buying them?
What the Fed is saying today is based on the data that we have today. And the Fed has been very explicit that they are backward looking. They base themselves on realized inflation data, realized job market data. And so they can't possibly tell us what they will be doing in the second half of 2023 if they use backward looking data from 2022. It's as simple as that. That's the reason why we're still in team cut. Now, is that relevant for fixed income markets? Not really. When you have a period of very high volatility like we have now, no one really has an investment horizon of, over a year. Like very few people can just buy treasuries now and say, well, 4%, it's going to be a really good level when I look at it 1 year down the line. In the meantime, you have to see through a lot of volatility. And what really matters in the near term is that Fed rhetoric you just talked about, that upside in yields and perhaps even a better entry point, even if you have this long-term buying horizon, as I just mentioned.
So do you not believe we've seen the peak in yields yet?
No, probably not. I think we're going to touch over 4% soon, probably go over that, 4.25%, completely possible for 10-year. For the time being, this Fed rhetoric is just as strong and consistent as it can be. The only thing that could really prevent us from touching that 4% level again would be a catastrophic fall in jobs. But for now, the news flow on the economic front has been mixed to slightly positive, even, I would say.
I recently showed a chart, 2440. I was just looking for the number, and if the control room wants to pull it up, sorry for the short notice, but 2440 is a chart that shows financing costs have just absolutely soared, Antoine. This is in Europe, but of course the same is true around the world. How does this position businesses? How does this position consumers? And what does this mean for the kind of recession that we're likely to see?
It's not good news. That's fair to say. Clearly, we always talk about the long and variable lag between monetary policy tightening and the impact on the economy. And so this will take a long time to feed into corporate balance sheet, into households balance sheet. And ultimately, we're going to see a recession. The sort of recession that not economists in an official definition of a recession, but what most people would define as one, which is an increase in unemployment rate and job losses. And the definition of recessions is that we kind of can define where they start when unemployment starts rising. It's very difficult to know when they stop because these economic processes have a tendency to be self-fulfilling. Consumption cuts, therefore people lose their job, consumption falls, and so on and so forth. So it's very hard to subscribe to the view that this is going to be a soft landing, that only the adjustment or the loosening of the job market will be done only via a fall in job openings. I think this is a very optimistic take, and in all likelihood, we'll see a recession in 2023.
I think
so much so the Fed will be in a position to cut rates.
The problem is kind of with the metaphor, right? Because we're not exactly flying high right now, so it's difficult to imagine a hard landing, so to speak. Nonetheless, we could dip low, much lower than sea level here. if we get unemployment at 5%, at 5.5%, at 6%, when does the Fed flinch? What do you think pushes them?
It's the job market. I mean, we've talked about this already abundantly, but ultimately, as much as they're targeting inflation, Powell channeling is in a Volcker, all these references to the 70s mean only one thing, is that the Fed is not concerned with inflation falling with the recession. They are concerned with inflation jumping back as soon as the recession is over. So the key to that dynamic is, of course, the unemployment rate and the job market more broadly. We need to see the unemployment rate rise to 5% or perhaps even higher, as you just mentioned, for the Fed to be convinced that the fall in unemployment rate is sustainable. And so then, only then, will it be in a position to cut rates. That, we think, is in the middle of 2023, but it could take longer.
Antoine, I want to wrap things up with the ECB because we had, of course, accounts yesterday in the middle of all the noise around the Fed and Fed officials speak. I wonder what you make of an ECB that sounded perhaps more comfortable with 50 basis points, but is really ready to start that QT debate.
Well, to be honest, and I don't want to discredit the ECB here, but they've looked at what the Fed's done. They see that it's working. The market's assigning credibility to the Fed. If you look at the volatility in dollar rates compared to the volatility in euro or sterling rates, clearly there is a reward for central banks who have stepped into the plate, hiked aggressively at least until the neutral rate, and the ECB is nowhere near the neutral rate. We might be at that level in December. It's probably 100 to 150 basis points higher. For now, they're basically on autopilot. That debate on quantitative tightening, I don't know how long you have. We could say a lot of things about it. I'm just going to summarize it this way. It's a mistake. I think quantitative tightening would help at the margin with inflation, but it would pose a much greater risk to the fight against inflation in the sense that it poses financial stability risk, as we've seen in the UK. So, the trade-off is not very good. It helps a little bit with inflation, but it poses financial stability risk. Ultimately, this financial stability risk could prevent the ECB from tightening as much as they want, as much as they should, to fight inflation.
All right, we're going to talk about financial stability risk as well later on the program. Antoine, thanks so much for joining us. Great to get your insight on this ahead of the jobs number. Antoine Bouvet, ING Senior Rates Strategist. Coming up, we're going to talk U.S. jobs with Ryan Wang, HSBC U.S. economist. What does he forecast? Consensus is for 255,000 at 8:30 this morning. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. You're looking live at the principal room. Coming up later today, an interview with Rick Reeder, BlackRock CIO of Global Fixed Income. That's at 9 a.m. New York time, 2 p.m. in London. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Matt Miller with Kailey Leinz in New York and Danny Berger in London. Now, as the world holds its breath, waiting to see 4% U.S. unemployment, so the Fed's aggressive hiking can moderate, at least that's the narrative. Markets have gotten very excited about some early signs of the U.S. labor market slowing. Bloomberg's Valerie Teitel is here to take us through the chart showing the glimpses of hope and hurt for a Fed pivot as the arguments against it sort of rise and fall. Valerie, what do you got?
Thanks, Matt. Yes, we heard time and time again from FOMC members and especially Powell at the last meeting that a tight labor market is the key fundamental driver for this late cycle inflation we're seeing, and we need to see cracks before the inflation narrative will turn. The market was so keen to jump on two themes this week that jumped out that showed there might be some cracks. The first was the JOLTS data we got out Tuesday that drove a huge bounce in risk assets. The ratio of job openings per unemployed individual dropped from 2 to 1.7. This 2 number was specifically mentioned by Powell in his testimony and in his questioning. So there was a bit of relief in risk assets when we saw this fall to 1.7. But analysts on the street notes that, hey, yes, it's gone lower, but look at the 6-month average. We are still way, way, way elevated to history. This is going to keep pressure on wage growth. As we know, it's expected to be 5% today. This will continue to drive wage gains into year end. Second chart was on jobless claims. Yesterday, they came in above estimates for the first time in 9 weeks at 219K. But analysts would say again, look, jobless claims 4-week average of around 200K with wage growth at 5%. That is not a recipe to get inflation down to 2%. We still have a long way to go in terms of seeing cracks in this labor market to give any reason for the Fed to pivot.
All right, Bloomberg's Valerie Teitel. Great work. Thank you so much. Joining us now for more on today's jobs report is Ryan Wang, U.S. economist at HSBC, who is up early for us in New York this morning. Ryan, we appreciate it. Thank you so much. Consensus has 255,000 on payrolls. You're up at 275,000 for today's report. Why are you there? And what do you think the Fed's going to make of a number like that?
Thanks. Pleasure to be here. Well, 275,000, that would be a little bit of a slowdown in employment growth compared with what we've been averaging so far this year. But it's really not slow enough to achieve what the Fed is forecasting over the year ahead. The Fed, we learned, is looking for the unemployment rate to rise to 4.4% by the end of 2023. And for that, we need a job slowdown below the 100,000 per month threshold. So 275,000, that would suggest that maybe there's been a little bit of cooling, but the Fed wants to see more. It wants to see those job gains slow. It wants to see some of these wage pressures that are running through the labor market begin to lessen.
Well, Ryan, Valerie was just talking about the JOLTS data that everybody really clung on to as a sign that maybe there is some slack building in the labor market. Do you think it's more likely that people are having more success hiring, therefore there's not as many openings, or they're just abandoning their attempts to hire?
I would put it a little bit differently. The high level of openings, even though there's that tentative signs that it's coming down a little bit, shows that businesses still have extremely high demand for labor. So actually, if you think about it in those terms, they're not having that much success hiring as a proportion of how much demand for labor they have. At the same time, the demand is so strong that that's why we're still getting these job gains that are several 100,000 per month. So it's really a combination of forces. The Fed is trying to slow down that labor demand. It is trying to reduce those wage pressures. And so, for example, we can look at the 4% number, which is going to be key for two of the other numbers that are coming out in today's report. Wage gains, I think the Federal Reserve would like to see much closer to 4% rather than the 5% type of annual growth rates that we've been seeing recently. And the unemployment rate, as I mentioned, we already know the Fed is targeting an unemployment rate that would rise above 4% into 2023.
So if that pivot narrative, if we're still far from that, Ryan, it does feel like the new pivot narrative we've coalesced around is because of risk to financial stability. And we had Guggenheim's Scott Minerd saying that he thinks the Fed will press ahead with rate increases until something breaks. And he says that he's already starting to see cracks forming. Now, at the same time, we had Fed Governor Christopher Waller, who said that there are additional rate hikes into next year. But Ryan, I want you to take a listen to what he said specifically around financial stability at an event at the University of Kentucky yesterday.
I believe we have tools in place to address any financial stability concerns, and we should not be looking to monetary policy for this purpose. The focus of monetary policy needs to be on one thing: fighting inflation.
So, Ryan, I got to wonder, do you take this as the Fed saying, even if something breaks, we're still going ahead?
Well, again, I wouldn't put it quite like that. What I think Governor Waller's speech made clear was that the Fed is intending to press along with rate hikes, at least for the next several meetings into early 2023. And his comments also make it clear the Fed is watching financial conditions and the markets. Of course, the central bank has an objective to protect the functioning of markets. But at the same time, it's also about the transmission mechanism to the broader economy through business and household expectations and business and household borrowing. If the markets are disrupted to a point where corporate borrowing becomes impaired, that inevitably will have knock-on effects on the economy. And that's the type of development that could eventually lead to a change in how the Fed is talking about its monetary policy stance. But what Governor Waller is saying is that we just haven't reached that point yet. It's not that the Fed wants something to break, it's that they're watching closely, and at the same time, the primary focus right now is still on inflation and economic conditions.
Danielle DiMartino Booth at Quill Intelligence down in Dallas has has suggested that maybe the Fed, maybe Jerome Powell does want to break this idea that there's always going to be a Fed put. Maybe the Fed wants to convince markets they're not always going to be there when we see a huge drop in risk assets. Does that make sense to you?
Well, again, I think the focus is really going to be on the labor market. Markets are very uncomfortable with this situation because I can't actually remember a time, at least not in the past 2 decades, where the Fed has explicitly said it's looking for a cooling off in jobs growth. That by itself is something remarkable. And like I said, we may see some early evidence of that, but at the same time, 200, 300,000 jobs per month, that's not going to put the upward pressure on the unemployment rate. On the contrary, those types of numbers would still mean the unemployment rate is falling. So until we see a change in what's happening in the labor market, I think markets are a little bit premature in expecting a pivot, certainly to rate cuts. That's not really what we should be talking about at this point. The Fed needs to see a little bit of progress on both inflation pressure and in terms of wages to get to that point where it's comfortable holding the policy rate steady. That's what the Fed is looking to accomplish, and that's what markets are probably hoping for as well.
Ryan, great to get your thoughts. Love to have you back on. Thanks so much for joining us. Ryan Wang there, HSBC U.S. economist, talking to us about the jobs number and the situation with the Fed and markets. Coming up later, we're going to speak to U.S. Labor Secretary Marty Walsh. That's at 9:40 a.m. New York time, 2:40 p.m. London time, so just about an hour and 10 minutes after the jobs release. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Kailey Leinz with Matt Miller in New York and Danny Berger in London. Anna Edwards is out today. Now let's take a look at what is ahead on this Friday. Russian CPI data will be coming out at 12 p.m. New York time. President Biden will travel to Hagerstown, Maryland, where he will deliver remarks on building the economy from the bottom up and middle out. We'll also hear from even more Fed speakers, as if we haven't gotten enough this week, including New York Fed President John Williams, Minneapolis Fed President Neil Kashkari as well. And of course, they will have to be reflecting on the U.S. jobs report that is released at 8:30 a.m. Eastern time. So just about 2.5 hours to go. And ahead of that, we are going nowhere across asset classes, Matt. Not even a basis point move on the 10-year yield. The dollar is essentially unchanged. Futures essentially unchanged. This is a market waiting for payrolls to give it direction.
Yeah, absolutely. And I mean, we say this every month, but a lot of times around these big releases, around Fed decisions or non-farm payrolls, traders will actually turn off the computers that supposedly do all of the work in these markets and actually wait until humans have a look at the decisions or the data that comes out. So that's why you won't see a lot of volume and you won't see a lot of volatility, Danny, as I understand it, around these big releases.
Yeah, maybe turning off their computers, but hopefully not their TVs. We have a great continuation coverage of Jobs Day. But you know what's really, I think, a very fun fact and maybe telling fact for this Jobs Day? This is Dan Curtis told me this, so all credit goes to him. The spread between the highest and lowest estimate for jobs at the moment is 190,000. Kaylee, that's the tightest spread since the start of the pandemic. So maybe we've finally got it together, or maybe the tail risk is really big for this one.
Well, the fact that that is the narrowest spread we've seen in some time and it's still close to 200,000 is remarkable. And it just goes to show you how hard it has been to forecast this economy, considering it was a recession unlike anything we've ever had, a recovery unlike anything we've had, and of course, monetary policy that we haven't seen in quite some time as a result, Matt.
All right, well, we're all waiting for the 8:30 release. Stay tuned to Surveillance for all the details and all the commentary that you need. This is Bloomberg.